Hey everyone, welcome back to Upside Down Data. Today I want to talk about the Fed interest rate hike and what that means for macro and for crypto. If you like the content, remember to subscribe to the channel, give the video a like and follow us on Twitter. Got a lot of updates, better indicators, and more over there. So if you've been following along, one of the things that I've been talking about on this channel forever, really what's been my base case, my thesis of the crypto market ever since we entered into this very nasty bear market, is that macro was driving the ship. That really it was unlikely for Bitcoin and crypto in general to stage a meaningful reversal in trend until the macro environment started to let up, until that macro pressure started to let up. And just today, an event happened that kind of fits into this whole macro saga. The FOMC meeting happened where the Fed announced their interest rate hike, and they ended up hiking by 75 basis points, which was in line with market expectations. This was kind of the base case in the market. And now what a lot of people were thinking coming off of this meeting was that if they did this, it would be green light for risk assets. People would see that as being a generally bullish sign that they came out at expectations. They didn't hike more than expectations. And that should lead to at least a short-term rally. And as we can see now, that didn't materialize. You can actually see with Bitcoin, if we look at this candle here, there was this big wick to the upside where the market did try to rally pretty notably, going all the way up close to about 20K, but then it got rejected and actually ended up closing lower. And in fact, it closed at the lowest level we've seen in this bear market so far. We haven't taken out these wicks yet from June, down all the way to 17.5K, but we've been closing at levels that are lower than where we were closing for a lot of this time here. And so, that would be concerning. So, crypto is being hit, but what I want to talk about more in this video is because I think macro is driving the ship, in some cases it's not all that useful to be looking at the Bitcoin chart right now because, again, it's not really moving on its own. It's really being driven by what's happening elsewhere. I want to talk more about how the rest of the market reacted to this news, and then what we might infer going forward, or what signs would we have to look for to get more hopeful of Bitcoin being able to find a more solid bottom. So if we move over here to the stock market, so this is the S&P 500 I'm showing you here, the stock market really hated this news, actually to a greater degree than Bitcoin did. You can see the S&P 500, closing down this big red candle right here, down on the day about 1.7%. So not totally insane, but for the stock market, that's a pretty decent sized move within a given day. And so, very negative reaction to the news basically. And the rest of the indices show the same pattern. The NASDAQ, closing well down in the red at the end of the day. Same with the Dow Jones. So the stock market was not pleased with this news. And what's interesting about this, what's notable about this, is that this was expectation, right? The Fed raised interest rates at expectation, but yet the market still sold off. So why might that be? There's different reasons. One possibility is that people hadn't quite priced in yet this event. The other possibility is that some of the other things that were said at the meeting is more what the market's reacting to. One of the things that was talked about was basically this idea of having to raise rates, but then also having to keep rates high. And so many people in the market have been kind of betting the farm on this kind of early Fed pivot, that the Fed will kind of blink. They'll pause a lot earlier than they have been making it sound like they will. And then that would be a green light for risk assets. So people are trying to front run that possibility. So part of this might be just some market participants finally giving up on that idea, saying, okay, maybe this pivot isn't going to actually materialize based on what I heard. Therefore, time to change the outlook on the market, maybe de-risk, and that sending prices lower. Interest rates are expected now to be up at around 4 to 4.5, I think somewhere in that ballpark percent by the end of the year. And then expectations leading on to that is that rates will stay extended for a while after that. There's not going to be this massive cut down to close to zero like what happened in the pandemic. And so it's hard to know, really what's going on. It's a lot of market participants, but clearly this was not all priced in. And so this was not, the reaction was not all that positive in the stock market. And the bond market actually showed a very similar reaction, or it's been showing a similar reaction really ever since the big inflation print came out ahead of expectations for the August CPI. If we look at the 2-year Treasury bond, you can just see how yields have been just going on this massive rip to the upside, just blasting way above this range from the highs in June, just ripping off to the upside, now crossing above 4%. And again, when you're looking at treasury yields, the higher the yield is, the more that bonds are being sold off. And again, the reason that people would do this is that they're saying, okay, I trust the Fed more to hike to these higher interest rates. Therefore, I'd rather just buy bonds when they're at the highest possible interest rate I can get. That bonds basically are not worth as much now as they will be in the not too distant future. So therefore, selling off kind of lower interest bonds becomes more logical, because you expect interest rates to go up. And if you're believing the Fed more and more now, then this seems very reasonable. And so the 2 years now breaking above 4%, which makes, frankly, a lot of sense if the bond market is starting to believe the Fed more. And the reason I'm showing the 2-year Treasury bond is that it's a really useful one to look at to actually get an idea of what the Fed is likely to be doing. And so when I say that, let me go ahead here and just pull up the Fed fund rates here on the same chart here. So this orange is the Fed funds rate. So this is the interest rate. This is what just got raised today. And the reason why we care about the 2-year is that it tends to act as a leading indicator of what the Fed does. The Fed oftentimes kind of follows the 2 years. So you can see back here in 2018, the 2-year rolled over and started going down way before the Fed even stopped raising, and certainly before they started cutting, kind of giving this leading indicator that as this was dropping, the Fed was entering their end game, that it wasn't likely that the Fed was going to keep on hiking for all that much longer. And in fact, then cuts might be coming not too distant future. And then likewise, coming out of the summer of 21, the 2-year Treasury bond acted as this massive leading indicator of the Fed just going and tightening financial conditions so extremely here. In fact, all the way back here is basically screaming that inflation was something maybe to be taken seriously, and that the Fed was likely to be reacting. And sure enough, here we go, things going off to the upside. So that might also mean then is that we'd want to look for is signs of the 2-year starting to roll over, because that might mean that the Fed is getting near that end game. Haven't seen that yet by any stretch of the imagination. In fact, this is just this massive acceleration. It looked like the 2-year was kind of slowing down over this period. This is now just going back to parabolic as it had before. Now, again, if the Fed is expected to kind of tap out somewhere in the 4 to 4.5% range, that might put somewhat of a ceiling on the 2-year of how much further it's likely to continue to rally from here. But certainly right now, there's no signs of it turning over. And so that's, not a good sign for risk assets, right? Because that's not giving us any indication that, interest rates have maybe gotten where they want to go, because again, the bond market tends to be pretty good at sniffing out when the Fed is getting close to the end and actually can start front running those moves. So this is something that I keep an eye on, the 2-year, and if it does show strong signs of rolling over, that would be a bullish sign. Again, we haven't seen that yet. And a similar story can be told about the dollar. You can see the dollar had a very big move up after the FOMC meeting after that day. And again, the dollar tends to move up when risk assets tend to go down. They tend to be inversely correlated. And so the dollar's just been ripping to the upside. And, people have been talking, ad nauseum about how the dollar was ready to roll over, to crash, fall off. Haven't seen it yet. Not really any signs of the dollar stopping anytime soon. And I think there's some reasons for this. I've seen some analysis which I think makes a lot of sense, where basically the idea is that, the dollar, the DXY, is the strength of the dollar relative to other currencies. Most specifically, or at least the ones that it's weighted most heavily against, are the euro and the yen. Both of those currencies have not been doing well recently. In fact, both the central banks for Europe and for Japan have been quite a bit more dovish than the US Fed has been in how they've been reacting to inflation. They've not been tightening monetary policy nearly as tightly or as quickly as the Fed has. And so what some people argue, and I think makes sense, is that there's not really much reason to expect the dollar to slow down until the Fed does end up pausing interest rate hikes, or does just generally reduce the tightening of financial conditions, or until the European Central Bank and the Japanese Central Bank get more hawkish. And until that happens, there's probably not much reason to think that the dollar is going to lose momentum here. Certainly that's what we've been seeing. The dollar is not showing any signs of rolling over in a meaningful way so far. So I think we're going to have to watch. But I think what cuts through all of this, and what's crystal clear now, is that the market is still primarily concerned about inflation, not recession. And that's what the Fed is basically saying. You know, one of the things that Jerome Powell actually said today was that, you know, he thinks the labor market in the US is too tight, that unemployment needs to rise, and that growth needs to be slowed down. Basically kind of saying in quiet that we need some kind of recessionary pressure. You know, obviously he's not going to come out and say that he wants a recession, but that's more or less what's kind of being intimated there. Kind of a reduction in growth. Basically, a recession might be needed to kind of get us where the Fed wants us to get to with inflation. And certainly then the markets are still very much paying attention to that. But the markets don't think that, you know, the Fed's not really caring too much about a recession yet. Inflation's still driving the narrative. Markets seem to generally still be holding on to that as well. It's news about inflation that have really been moving things along, not so much concerns about recession yet, which is why I think some people were speculating was going to be a pivot that was going to happen earlier on in the summer. Now, some, you know, good signs, potentially on the inflation front, if that really is driving the boat, is that we haven't seen commodities, you know, start to revive yet, to pump again. You know, I'm showing you the price of oil here. We've just been in this steady downtrend really ever since back here in June, and that hasn't reversed. You know, that has not shown clear signs of bottoming. You know, the speed of this downtrend has been decelerating, but still it is not, you know, ripping off to the upside. And if we just look at commodities in general, so this is just the GSCI commodities index, so just tracks a basket of commodities. Again, generally speaking, in a downtrend, not showing signs of a strong reversal to the upside. So as long as that continues, that would be a hopeful sign for inflation, because of course high commodity prices means higher inflation, generally speaking. But I think what also is the case is that people have seen this in the market, and I think this is part of what a lot of people thought inflation was going to start falling quite rapidly, probably partly why the market reacted so negatively back when we got the August CPI, is that, you know, despite this, inflation still proving to be more sticky, that's not just falling off a cliff, or at least maybe falling off as much as some people thought. But certainly, you know, so far so good. And so I think, you know, the likelihood of inflation continuing to fall seems reasonable, you know, assuming that some of these pressures continue. But certainly the market is still primarily concerned with inflation. And so really then going forward, if we're just thinking about Bitcoin and crypto, you know, if we want Bitcoin to hold this range and not take out its June low down at 17.5K, you know, you better hope that the stock market finds a bottom before setting in new lows. Because in my opinion, you can bet dollars and donuts that if the stock market goes in and sets a new low here, there's no chance in hell, in my opinion, that Bitcoin's not going to set a new low. I think then we're off to the races to the downside. And, you know, we've talked before about how if we lose this level, you know, it suddenly becomes the 12, 13K range that becomes the next plausible level of support, which would be a pretty nasty move to the downside, right? You know, that would be all the way down, you know, going down about 30, you know, 25, 30% to the downside or more from current levels. And then, you know, altcoins would probably get hit even harder. So not anything that we want to see. And so that's where I think we're really in, you know, Ethereum too. I think, you know, Ethereum's been falling off of the merge. Same thing I think would happen. So really with this, what I'm going to be watching very closely is what does the stock market continue to do? Because if this continues to go down, then I see no reason why Bitcoin won't continue to go down. And if we do lose these lows, watch out below potentially. It could get quite dicey. So those are the different kind of macro considerations that I'm watching right now. I think the bond market, you know, the DXY, commodities, they're all giving us information. And again, it's frustrating that it really just does seem to come down to inflation and how the Fed is responding to it. That really there's nothing that anyone can do. We're just kind of here just watching the fireworks unfold. And, you know, how low we have to go really just depends on how inflation shapes up, or how rapidly it might become the case that recessionary fears take over consideration. You know, is the Fed going to be able to continue being this hawkish in the face of actual economic pain? You know, should unemployment start spiking, how far are they really willing to go? There's some people who say that the Fed will go as far as it takes, no matter what, to tame inflation. Other people are less optimistic. That becomes more just a thesis kind of battle of what you think the Fed is willing to do. But I think in the shorter term, as long as we're not there yet, inflation is going to continue to drive the narrative. So watching things relevant to inflation is what I think might be useful. So none of this is financial advice, of course. just some thoughts that I have coming off of the FOMC meeting. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. A lot of updates, better indicators, and more over there.